Hello, I'm Greg Bonnell. Welcome to TD Active Trader Live, brought to you by TD Direct Investing. This is your educational one-stop shop for in-depth market analysis, investment insights, help boost your trading potential. Coming up, technical analyst Will Tamplin is watching key support levels for the S&P 500. He says some momentum indicators are waning, but not signaling a breakdown. We're going to hear more from him in just a few minutes' time. Plus, he's also keeping a close eye on the small caps, which could benefit from seasonal strength in December. And later in today's technical take, we're going to dive into NVIDIA's chart ahead of next week's key earnings, what it could mean for the AI trade. That's all ahead. Don't forget to like and subscribe. You're watching TD Active Trader Live. To the trading day, let's check in on the S&P 500. We got some downward action today. The U.S. government shutdown is over, but in a world addicted to drama, I'm just waiting to find out what's next. Let's check a look at the heat map. I want to see where the weakness is today. It's been a really choppy trade in tech. Right now, we got NVIDIA down 3%, Microsoft flat, Broadcom, Google, Oracle, we're going to talk about them in a second's time, all to the downside. I think Oracle is supposed to be my example of something that was to the upside. So let's jump into some of these different. No, Cisco is actually my example of what is to the upside today. A beat on the top and the bottom lines. 4 straight quarters of revenue growth. This is after years of declines. The Street likes what they're hearing here. Of course, it's about data center spending, focusing on AI. They say the book is strong there. Disney, though, some mixed results for them. Beat on earnings, but missing on the revenue expectations. The company's entertainment unit is buoyed by strong streaming numbers, but linear TV, well, that's in decline. I don't think we're getting many surprises there. And of course, the ad revenue hurts when the linear TV is in decline, but Disney Plus, that flagship streaming service, adding 3.8 million subscribers during the quarter. They now have over 131 million subscribers, and that has the stock actually down in the session right now, and some of those mixed results. And that's your market update. Joining me now from London, Ontario is my colleague Hiran Amin from our Direct Investing educational team, and Will Tamplin, Senior Technical Analyst with Fairlead Strategies, joining us from Stamford, Connecticut. Before we dive into the conversation with the gentleman, just a reminder to our viewers, the views and the forecasts expressed are solely those of Will and his team at Fairlead Strategies and based on their research. Will, S&P 500 has been choppy trade lately. You're watching the technicals. You have a close eye on the 50-day moving average. What is it telling you?
Yeah, that's right. The 50-day moving average, it's been support for the S&P 500. We've seen short-term market bottoms there over the past couple months. Most recently, last Friday, that level was able to hold. It's around 6,700 on the S&P 500. So if that level is taken out in our work, that would constitute a short-term breakdown. We have upside momentum behind the market, but it's less so than it was this summer. And so if we do see that breakdown below the 50-day moving average, our momentum gauges will likely see that more decisive shift lower in a bearish indication, suggesting that we might see a more significant correction than the minor pullbacks that we've seen really since the April low.
So, Will, when we start thinking about possible corrections, about the April low of last year, which was quite dramatic, I start thinking about the traditional ways we take a look at risk in the market, whether it's the U.S. dollar, whether it's bond yields, whether it's gold. Some of these asset classes, they're starting to move in tandem. I'm used to them moving separately from each other to tell me things. What is it telling you about risk appetite?
Yeah, so first off, I'll say that correlations can break up in the short term. So it's something that we don't rely solely on, is correlation between asset classes. But gold has certainly been strong. It's still in an uptrend. It does look poised to consolidate in here in the short term with a overbought sell signal from one of the indicators that we tracked, but still a long-term uptrend that looks healthy. Gold and S&P 500 have been moving in tandem, which is somewhat unusual. The parabolic move in gold can be seen as the recent parabolic move in gold can be seen as somewhat of a risk-off trade. But bond prices have been relatively subdued. They're off the lows. They are improved somewhat, but we haven't seen that major breakout yet in bond prices. So that's not really giving us quite the same signal yet. But for the equities, we're going to rely mostly on the momentum, price action that's really going to tell us whether this trend has shifted in equities.
All right, well, and let's actually bring our conversation back to equities, because we know that a lot has been made, that a lot of this movement that's been happening on the S&P 500 and the tech, it's done by a handful of names, of course, in the AI space. And what is that really telling us about breadth? Breadth. Is it bad breadth, no pun intended, or are you seeing some real improvements in breadth going into the end of the year over here?
Yes, we've seen breadth improve earlier this week with that bounce off the 50-day moving average, but really it doesn't compare to the negative divergences that we've seen really over the past several weeks in breadth, and our breadth metrics not confirming new highs for the equity indices. So that deterioration in breadth that we've seen over the past couple months is something that we take note of. It's not an outright bearish indication, but it's something that would tell us that if we do see that breakout in the S&P 500, we want to be respectful of it. So the negative breadth divergence, it puts a lot of weight on those mega caps, like you said. So we have NVIDIA reporting earnings next week. It just increases the stakes around that report with a stock that's roughly 8% of the S&P 500. So yeah, it puts a lot of strain on the mega caps to keep the market upright.
Yeah. And you know what? We've also seen with a little bit of those minor corrections happening, it's not so much that it's the overall index. We are seeing a rotation taking place. So shifts maybe in leadership taking place. I know two sectors that you're particularly interested in is healthcare and energy, which is starting to show strength. So do you think this rotation has legs, or is it just a bit up in these sectors for a wait and see moment on how the AI narrative plays out?
Yeah, so one of those sectors is healthcare, and I do think that's a sustainable shift in healthcare, which makes it look improved going into next year for 2026. We have major trend reversals in healthcare benchmarks like XLV, and we have a long-term channel breakout in Eli Lilly, which is kind of the healthcare version of NVIDIA. So a lot of the heavyweight pharma companies, Johnson & Johnson, another one that's near new all-time highs. Even Merck with a breakout through its 200-day moving average looks improved. So some of these big pharma names have seen some bullish trend reversals, and it's really helped drive a breakout in the healthcare index more broadly. And really the relative strength there has turned the corner in our view. So we do think that healthcare can see positive relative strength continue into year end and potentially into the first half of next year. And then the second sector is energy. So particularly in the oil services names, when you take a look at an ETF like OIH, we did have a long-term trend reversal there. There was a trend line that we were watching that was cleared. And so that just signals a shift or an improvement in long-term momentum. So that downtrend, that cyclical downtrend that was in place for the oil services names has been reversed, suggesting that we can see those assets trend higher. And we're watching crude oil, which is stabilized above support near $55 per barrel. There's oversold indications there and a loss of downside momentum in crude oil within the context of a broader downtrend, I would add.
All right, so some interesting ideas there, healthcare and energy for our audience to take a look into. You mentioned NVIDIA earlier, reporting next week. This stock has been the poster child for the AI trade. When you look at NVIDIA's charters, even the sector more broadly, I think a lot of people wonder, on a day like this, when NVIDIA pulls back again, some of the other chip names, are these buying opportunities? Is there still room to run? Are they starting to roll over? What are the charts telling you?
Yeah. So there's definitely uptrends intact for some of the AI benchmarks that we track. Semiconductor ETF like an SMH still uptrends are intact there, supported by rising moving averages like the 50-day moving average, similar to the S&P 500 really. NVIDIA has support near 180 that we're watching as a risk metric. So trends still intact, but we do show signs of upside exhaustion in those names from our overbought, oversold metrics that we track, and it supports at least some digestion here in the short term over the next few weeks. And we've really already seen that kind of happen. You mentioned the choppy trading that we've seen in the near term. So we expect that to persist for at least a few more weeks, just based on those overbought metrics that we track.
Okay. We're heading into what's usually regarded as a strong seasonal stretch for stocks. You know, you got the Santa Claus rally, we got the January effect coming just around the corner as well. So does the technical pictures follow the plot, or do you see any warning signs that outweigh the typical year-end strength that we usually have?
Yeah, so I think it really depends on the setup. I mean, right now, I think that technical picture is still intact with the major averages, fairly close to new all-time highs with positive momentum. If we do see pullbacks occur into the end of November, that could set up the market actually better for a year-end rally. If we do see that happen and we get an oversold condition leading into December. So that's something that would actually be kind of intriguing as a buying opportunity, if we get that. Another thing I'm watching, as you mentioned, is the January effect for the small caps. So the Russell 2000, typically you see seasonal strength actually start in mid-December for that January effect. So that's another chart that we'll be paying attention to. It's right near new all-time highs. And it's in a short-term trading range right now with support near 2,400 and resistance near 2,540. Obviously, if we see a breakout from that range heading into that bullish time of the year, that would be a bullish development and a reason to add some exposure to small caps.
Well, how should we be thinking about those small caps? I think there's been a number of times this year where people felt, because of course these smaller companies very tightly levered to the fate of the economy. Economy is strong, small business does well, the small caps should do well. Should we be thinking them as seasonal? Should we be thinking them as plays on the economy?
Yeah, I mean, I think that certainly if you see small caps decisively clear that range resistance, that would be a positive sign for the economy, because it's a key level on the chart. We had really resistance going back to 2021, so it's a major level on the chart, and if you can clear it decisively, it would suggest that investors are betting on a stronger economy, as you mentioned. And obviously the seasonals can really just add a tailwind to that breakout, and it would just strengthen the conviction behind a bullish move and a bullish follow through after that breakout, were it to occur.
Okay. You've also been more constructive on commodities as well, Will. Especially your natural gas is one you're looking at. So is this just going to be a short-term winter trade that we have, just now with Mother Nature kicking in here, or are you seeing a broader setup for energy into the next year?
Yeah, so for natural gas, I would say it's more of an intermediate term move for us. There is a long-term uptrend channel intact that we're watching, so it's slightly bullish. I would say it's not a steep uptrend with great momentum, but it's still an uptrend channel. Intermediate term momentum is positive there. We're watching 475 on nat gas futures as sort of an upside objective looking out into year end, and so we think gas is more of an intermediate term looking out into year end type of move.
Will, I want to ask you about Bitcoin, about crypto. We've had a full correction and then some. When you take a look at the charts for Bitcoin, what is it telling you? People are trying to, I think at this point, because we're just dancing around 100,000 on either side, trying to figure out, are we at a bottom? Is it time to get constructive again?
Yeah, so the 100,000 level is a key psychological threshold. It's not really technical support on the chart, I would say. We're actually watching more important support in our work in the 93 to 94,000 zone. That's defined by a Fibonacci retracement level and something we use called the Ichimoku cloud model, which can serve as support and resistance. And that cloud model has done a good job providing support for the long-term uptrend over the past couple of years. So, that 93 to 94,000 level is what we're watching. We think we'll see a test of that level sometime over the next few weeks before that correction ends. So we think there's still more to go for Bitcoin. But our oversold metrics are nearly there. So something like a stochastic oscillator is hovering right near oversold territory. So we think on this next leg lower, ideally into the mid-90s, we could get an oversold condition and a buying opportunity.
Well, lots of interesting stuff there for our audience to go through. Thanks so much for taking the time to join us.
Thank you for having me.
That was Will Tamplin, Senior Technical Analyst with Fairlead Strategies. And just a reminder to our viewers that the securities and strategies discussed on our show are for educational purposes only and should not be considered investment advice or buy, sell, or hold recommendations. Hearing lots of interesting stuff in that interview. I'm going to go back to near the top of it because, an old guy like me, when I'm trying to figure out risk in the market, I'm looking at what's the US dollar doing? Is it playing a haven role? What's gold doing in terms of a haven? And as Will was pointing out, you start getting these, these different asset classes rising together. He says he'd be watching price action and momentum when he's trying to judge risk out there in equities.
Yeah, exactly, Greg. There's so many dynamics at play when you think about the correlations of the market, and right now we're in an unscripted narrative that's playing out with so many of these what are considered safety assets moving in tandem with risk-on assets as well. But it's interesting to see just the breakdown when you think about the SPX level or the S&P 500 level, which we'll kind of dive into, but also. What got my ear was the breakout of the Russell 2000. He mentioned he was coming out of this big downward channel, and it's finally found a leg up coming into this year end, possibly, with the macro backdrop, with possibly quantitative easing, we could see those small caps being bid up as well. But also energy is at play, given that crude's sitting at 55 and, going into next year, I think they're not really expecting to pump out a lot more oil. So that should be stability for price and probably see if there's any more demand that could buoy up the price. So again, some interesting areas to look at.
Another great conversation for our audience to dig into. If you at home have a question for our guest or our team, here's how you can get in touch with us. Just email td.activetraderlive@td.com. And for more information about the Active Trader platform, scan that QR code on the bottom right-hand side of your screen. It's going to take you to our TD Active Trader Live website where you can try out the platform risk-free. Just open a practice account, you click on Try TD Active Trader, that button right there. Then when you're ready to switch to a live account, simply export your workspace, start trading for real. Let's continue the technical conversation with Technical Take. What's happening out there in the markets here? And you're going to take a closer look at the S&P 500.
Yeah, let's break it down, Greg. So obviously it's been, suffice to say, that's a drama-filled 2 weeks that have just kind of drawn to a conclusion now. A lot of the volatility, or we should see a lot of volatility now being driven by the resumption back of the government after the, I think this morning, in fact, President Trump signed them back, getting everyone back to work. Now, what this had meant was the biggest casualties coming out of this shutdown was the trio of inflation reports for October. Now, we don't think they're going to come back. I mean, it could come back, as early as, they're saying like into, a couple of weeks from now, but most likely may not make it by the time the Fed meets again back on December 9th and 10th there. So again, these are the key things, especially with the Fed now leaning towards looking at inflation again, given that it's sticky and, obviously the labor market's still there. But these are the two things that markets will really be focused on in the next coming weeks, is to see that flood of data coming back, especially from the BLS. And if there's any indication or any reports that could be summed up to give an indication of what those this consumer price or CPI numbers might be. So big things to look for in the S&P that's going to be moving is, one is we just talked about the data, but it's also the AI narrative as well, which we're going to go into and talk about in just a moment's time. But looking at the technicals, here's a key thing that I just wanted to break down. I've got the technicals mapped up. Kind of like what Will did, we like to look in these Ichimoku clouds, which give us a sense of where the trend is and if it's holding. So essentially, how you gauge with the Ichimoku clouds is if you see the price break above it, it is strongly in a bullish trend. And right now we are seeing it. It has kind of respected that since May. The price has been trading above those clouds. But more interestingly, you also have this rising wedge, Greg. Rising wedge is usually a bearish reversal pattern that forms when we see a break out of it on the lower end and a confirmation. Now, we did see what's known as a fake out, because you did see a close happen lower here. We saw another, we have this bottoming tail candle, which is really a bullish reversal candle, essentially, when you see it. You have a long wicking, bearish breakdown, but then you have the close, coming close back towards the high over here. And then we went back into the wedge again pattern. So we didn't actually get confirmation, because technically you want to look for 3 confirmations or closes below the wedge and making subsequent lower lows. So we didn't get that. Now, today's price action shows we just stepped out of the wedge again. But again, we don't have confirmation, so there could be, given the next few days, it could capture back and go back within the wedge. The key levels to look at, though, is 67.60 on the downside. This was a previous resistance area. It has respected it just most recently, bouncing off of that level. So that's a key level to capture. We should see a bounce if it does come down. And then on the top side, we see 68.90. And the big catalyst, of course, that might be a driver of this is going to be NVIDIA's earnings coming out of next week. So that's one to keep an eye on these levels going to the SPX into the couple of weeks' time from now.
All right, so let's talk about NVIDIA. Pretty hard to talk about these markets without talking about them. As you said, they're on deck for next week. What are the charts telling us?
Yeah, let's talk about NVIDIA. I just want to sum up, what the expectations are going to be. This is a make or break moment for the bull market, essentially. It's, as you called it, Greg, the poster child of the AI trade. And they have their earnings coming out next week, Wednesday, in the 19th of November, after markets close. Expectation is $1.25 on the EPS, which marks a 50% year-over-year growth, or 51.9%, and $54 billion on the revenue side. And the big thing that investors are going to be focused on is data center sales, which the bulk of it is usually driven, exceeding about $48 billion out of that $54 billion. The rest of it is made up by the gaming division. But also to hear more on the Blackwell production scales. That's their new shiny chip that they're obviously putting out into the market. So that's what's going to be keen for investors. The one other thing I will also mention is the China exposure. Jensen Huang, I think just from the last earnings to coming into this one, said they have a 0 market share right now in China. They did still have that write down. They've already accounted for it. So if there's any news on that, that could also spur the price momentum. But I just wanted to remind everyone, last time they slightly missed on data center revenue in Q2, and that ongoing US-China export restrictions really tempered enthusiasm, and the stock didn't move. So what we're going to have is, let's turn to our charts and see what NVIDIA is playing out right now. So here's NVIDIA's chart. We've got the daily charts pulled up. Again, we see a bullish channel that's formed here. It's pretty much respected and played along in that bullish channel over here. We just see along the way a key level, support level, is very much to the downside, is this 153 level, because we did see it break past. This was the previous year-to-date high for 2025. It broke and cleared it, respected it. So we know this is kind of the new really downside baseline that we have. But coming into this, we also form this inverse head and shoulders pattern. Now, this is typically a bullish pattern where we see a breakout, and then we saw a retest of the neckline. Again, it broke below it. But this is, again, they still has some momentum to move up. Now, coming into today's print, of course, this 21-day moving average, which is in yellow here, that's been respected. It's kind of mean reverting and hovering between the 21-day moving average. Going into this earnings print, though, we are expecting about a $15 to $16 move. So that means the key levels to look at will be on the resistance side, will be the 200. It needs to clear first, and then maybe retest closer to those all-time highs of 205, where we might run into some more major resistance at that point. At the bottom, I'm looking at the demand zone, which is 181 and 185. You can see previously, Greg, it's been bought up. Every time it's gone into this channel, we've seen a little bit of price action coming into it, most recently bouncing off of that and being bid up there. So this is a key on the downside level. We're looking at the 181 to 185. Right now, just to confirm with the momentum, we're still in positive territory in the MACD. RSI still holding just its ground, just broke below 50 today. But really, we want to see it, if it trickles anywhere near that or 30 level, that's when it'll go into oversold territory, which might be a bullish signal once it does reverse back up there.
Here, and you've done all this beautiful work on the chart. I know the audience is thinking, okay, how could I possibly play NVIDIA? Before you get started on that, though, just want to remind our viewers that options trading carries high risk, may not suit all investors. Significant losses are possible, so it's important to assess your own risk tolerance. Make sure you do your own due diligence before engaging in trading. Show us a few things here on the platform, Hiran.
Yeah, let's go for it. So I'm just going to we're going to start with the bullish trade, Greg. So what I wanted to do here was, let's hide this for a second. So if you are looking to play the upside on NVIDIA coming into this earnings report, one strategy you could possibly look at doing is a short put. So this is it's an income strategy, of course. We want to collect some premium. The way I think of a short put is like putting on a limit order for a stock, essentially. So most traders, when you put on a limit order, you're looking to acquire the stock at a lower price. But the difference with using an option, in this case shorting a put, is you get paid to do that. So here's how this works here. Now, coming into this earnings for next week, their options pricing is expecting about a $15.60 move either to the upside or the downside. So it's about roughly 8 to 8.5% move on the stock that's expected. I've mapped it out with these signals. Now, the strike that I've chosen is going to be the 180 strike for the December expiry. So this is roughly about just about 23 days from today. And the reason we wanted to look at this is we wanted to, when you're choosing your strike, especially for a strategy like this, is what's the price you're going to be happy at acquiring the stock for? So 180 is the kind of the strike, because if the stock does happen to fall, ideal situation is we don't want it to get into the 180 price zone, because that way we get to keep the full premium that we sold this option for. And you can see in this case, the premium we're looking to collect is about $5 on here because of the volatility earning into earnings. And that means our break even is going to be at $175. So if you net it out, really, if you do get assigned on this and the stock happens to fall down, your net cost ends up being $175 if you account for the premium that you get to keep on that trade there. I know, Greg, we like talking about the risks over here, so let's get into it. I wanted to hide it here and not show all my cards here, so I
was wondering where it was. It's like, where's my little risk box?
We got some magic going on here. Okay, so here, let's talk about the numbers. So the max profit, first of all, let's start with that. That is the strategy. Remember, it's an income-based strategy, so anytime we're looking to sell an option, ideal scenario is that it expires out of the money, and that's going to happen if NVIDIA stays above $180 by our expiry date. If that happens, we get to keep the $500. The downside, however, is what if the stock falls? And then if it does fall, we will start incurring a loss if it breaks below the break-even price, which is $175. Now, if that happens, the worst case scenario, and we always do theoretical worst case scenario, is if NVIDIA just flatlines and goes to zero. That means that's why you see this very exorbitant big number of 17,500 is what we stand to lose. But also, there's assignment risk I just wanted to mention. Again, this could be a strategy to enter the stock, but if it does fall below this price, you do get a risk of assignment where you will have to pick up NVIDIA shares at $180. And for a single contract, that'll be 100 shares. You'll have an outlay of about roughly $18,000 there.
Great. There was your bull trade. I love the drama of the reveal box after the fact. What else you got for us?
All right, let's flip the switch and let's go on to the bear trade over here. So what I'm going to do is let's go to our bearish trade that we've got on the charts, and let's hide this one again. So if you're looking to play a bearish trade over here, we're looking to look for directionality in this case. Now, given the Q2 report and the slight miss on the revenue, the stock didn't move a whole lot, but it did move to the downside. And that's if you identify that they could be a misstep on those numbers. This is one way you could play it. So what we're looking to do is a calendar put spread, and I'll walk you through it. So what we have in a calendar put spread is we choose the same strike as part of the strategy. In this case, we're identifying the $195 strike put, because we want to play the downside. But this is where the calendar comes into the name, is we're choosing two different expiry dates. For our long option, meaning the one we're going to buy, we're going out to the December cycle, the 19th December put, we're looking to buy that. And then for the shorter term option, or the one we're looking to sell to just reduce some of that cost, we're looking to sell the expiry coming into that earnings print for the 21st of November. Now, all of this, all in all, the cost is roughly about $3.80 for us on this, Greg. So we're spending, it's a debit trade, so that's coming out of our pocket, $3.80 to move for a trade to move to the downside. We do have our break even, which is accounting for the cost that we put in. So 191.20 is the line in the sand. We need the stock to fall below 191.20. And that's when we start making some money on this trade there. And should we do the great reveal again, Greg?
You want a drum roll?
All right, there we go.
I'll give you a drum roll.
Okay, so let's bring the numbers out. So the max loss, because this is a directional trade, we are going to lose what we put in. And this is a risk-defined trade, which is great about any time you do a long trade. You're spending $380, and that's what you stand to lose. That means if NVIDIA remains above 195 on expiry, then we will be out this capital outlay that we have. The positive side, though, the max profit situation is if the stock happens to fall, below our break-even of 191.20, we start making a profit. The best case scenario, again, theoretically, is if NVIDIA goes all the way down to zero, then we make about $19,120, of course. Now, keep in mind, because there's still a short option involved, you still do have assignment risk as part of this strategy. Again, because it's the same strike of 195, it does happen to fall. You may be put that stock at 195, meaning you'll have to buy to 195, but we are protected because we have a put that can also allow us to sell it if the stock moves against us to the upside for any reason there. So here's the trade there, the calendar put spread to play the bearish side.
All right, some interesting ideas for our audience. As always, investors should perform their own due diligence before engaging in trading. We're almost out of time for the show here, and we'll be back on Tuesday. You, me, Jason Natick in the studio, 10 a.m. Eastern time. What is the bull-bear debate on?
We're debating Sam Walton's company, Walmart. Of course, we're putting the retailer to the test, of course. Given with the macro backdrop, it might be interesting to see how they're shaking up. A key barometer of consumer spending there.
I know you guys will be meeting at high noon on Sunday down in southwestern Ontario to flip a coin, pick the names out of a hat to figure out who the bear and bull will be. It's a very dramatic ceremony. Maybe one day we'll capture it on
Old school Western
film.
style drawdown. That's how it is, Greg. That's how I like to put it. I'll have my cowboy hat on, boots on, so just for extra added effect.
Jay, I just pictured Jay in cowboy boots and the boots and the hat. He'd be formidable. All right, good luck with that, and we'll see you on Tuesday.
Thank you.
And thank you for watching the program. We'll see you again on Tuesday.